Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC.
I want to welcome you into, and thank you so much for joining us here on America's Retirement Headquarters. It is the home of the Retirement Guys Formula, Retirement Tax Partners, and America's Medicare Associates with Nolan Baker. ARHQ.com is the website. Find out more about Nolan and his team. Set up a time to speak with them. ARHQ.com. You can also give a call, 419-794-3030. That's 419-794-3030. Today on the show, we're going to find out how important it is to actually realize how much you're actually paying in retirement, and why some grandkids are skipping over their kids and giving their money to the grandchildren instead. But before that, you want to talk about a long time coming. Ticketmaster is now showing how much you're going to pay for tickets, including fees right there from the start. The FTC kind of had to nudge them in there with their recent ban on junk fees. So now, instead of getting sticker shock at checkout, well, you can get that sticker shock right away when you're searching for tickets. It is admittedly nice to know how much you're actually paying up front, those fees disclosed, but that is not the case when it comes to many retirement accounts. Nolan, how do you and the team show someone how much they're actually paying?
Well, you can have killer retirement fees that just absolutely erode your total growth that you have of your portfolio over the course of time. And you really need to understand how much you're paying for in retirement time and making sure that you're getting value for that. I'm not saying that the cheapest is always the best, but cost absolutely counts when it comes to retirement planning. And I would agree. I wish that the industry would be more transparent. We see an example here of like Ticketmaster. My wife and I, we recently went to Les Miserables at the Stranahan Theater, and, with the FTC kind of nudging Ticketmaster to have full transparency, it's nice to be able to go on to Ticketmaster, whether you're going to a concert or whether you're going to a show, and know the full price up front. It's been so frustrating for a long time that you would go through this entire process of getting a ticket only to get to the very end and to see all of these extra, junk fees that are added onto it that in some cases nearly double the cost of what the ticket price would be. And the problem with retirement accounts is, most retirement accounts are still hiding fees like it's the 1990s. And you could be paying thousands of dollars more than you think for your retirement management and really never even know it. So what I want to do is I want to show you exactly how to uncover those fees in your retirement account and take a look at them. What we had here is you have, again, the disclosed expense. Like in Ticketmaster's example, you might have a $50 ticket, but all of a sudden it's $85 at checkout because you have $35 or $35 of other fees and expenses. And now with Ticketmaster, you see the $85 is the total fee and expense. So there's no more sticker shock that you have, when you're buying tickets. You're able to make better decisions about where you want to sit, what shows you want to go to. In the retirement accounts, it often doesn't work the same way. What happens is you have various levels of fees and expenses, and sometimes those fees can be buried in the fine print and also be expressed as a percentage term. And so it can take you a little bit of homework to figure out what that is. But let me show you just an example of 1% difference and what a 1% fee reduction can do over the course of 30 years on, say, $100,000. So you have $100,000 and the time frame is 30 years, and let's just assume an average rate of return of 7% before fees and expenses. In the two scenarios, scenario one, we're going to say they have a 1% annual fee, and scenario two, they have a 2% annual fee. So the net investment on scenario one is you're going to take 7, the expected rate of return, subtract 1. It's going to have a net return of 6% after fees. After 30 years, that balance would grow from $100,000 to $574,349. Paid in total fees of $145,651, and the money growth with $474,349. In scenario number 2, what we're going to do is we're going to use the 2% annual fee. So we're going to take, again, a 7% assumed rate of return, subtract 2%. Your net rate of return is 5%. The final balance at the end of 30 years is $432,194. The total fees paid over the 30 years, $231,806. Your money growth is $332,194. So in adding up, the total difference, the final balance at the end, and the difference is about $142,144, a 1% fee. The bottom line is if you're going to pay fees and you're going to pay cost and you're going to spend an extra, say, $142,155 over 30 years, you really want to make sure that you know exactly what value you're getting by paying those excess fees and losing out on that potential growth that you have. You want to make sure that every dollar that you have is working as hard as possible. And, using that real world example, if this $100,000, if at the end of the time of 30 years, if that's what it grew to be, and that was going to be your retirement nest egg, if we were using the 4% rule, the 1% fee account using a 4% withdrawal rule would allow you to take out $22,974 a year of income after that 30-year investment. The 2% fee account would only allow you to take out $17,288 a year of income. So that's a pretty big difference. It's $474 a month of less income just by paying a 2% fee versus a 1% fee. Big difference when you look at, what that is. It's estimated, I think, that Americans pay, lots of money in excess fees and expenses when it comes to their 401ks. People that own variable annuities tend to have a lot of expenses. In retirement accounts, where you could have some of these fees and expenses and where you want to look for. With a 401k or a 403b, those would be administrative expenses. That could be for record keeping, accounting. Next, you could have investment management expenses. There, what you're going to have is you're going to have expense ratios. You can go to websites like Morningstar.com and you can type in the different funds that you have. And a website like Morningstar will show you what those expense ratios are for the different funds. There could be funds that are more index-based. Index-based fund, tends to be more cost-effective than a actively managed fund. Those tend to have higher expenses. It could be, whoever the service provider is that you have. In my opinion, between Vanguard, Fidelity, and Charles Schwab, 3 great companies that, nowadays tend to compete to be the most cost-effective company in the industry today. So some of those companies can help with being cost-effective with some of the plan services that are offered in 401ks and 403bs. The same could apply too when you have an IRA, an individual account. Again, who you do business with can make a difference. But in IRAs, some IRAs have annual maintenance fees. You can have transaction expenses. So, what do they charge you to buy or sell a stock or a mutual fund? If you're working with a professional, they could have advisory fees on the account. The company that holds the money could charge you a custodial fee. And then again, if you're investing in mutual funds or ETFs, you would have some fund expenses, and you'd want to see how your fund is doing in comparison to everybody else that's out there. You might be watching this segment and you might be an annuity owner. So with annuities, what you'd want to look for is your mortality and expense charge. You'd want to look at what are the administrative fees. If you ended up surrendering your account before your contract length, understanding what surrender charges could apply. If you have an annuity that has a rider on it, understanding what your rider expenses are. If you're working with a financial advisor, a lot of times you'll have what is called an AUM, stands for Assets Under Management fee. You could have some type of planning fee as a consultant. And then other times there's still some financial advisors that work on more of a commission basis. You'd want to understand what that is. So to uncover these, what you really want to do on your 401k or 403b, you can request a copy of what is called your plan summary description. Look for the section 404A-5, which is your fee disclosure. You can also check your quarterly statements. Again, you can use some of the resources if you have mutual funds like I was talking about with Morningstar. For your IRA, what you want to do is you want to read what your account agreement says. Again, you could check if you get physical prospectuses in the mail for expense ratios, or you can use online sources to look at what the fund expense ratios are. And of course, pay careful attention to your monthly or quarterly statements that you get. If you have a managed account and you're paying a management fee for AUM, assets under management, you could always request a free breakdown in writing. You want to calculate the dollar amount, not just the percentage of what you're paying. Ask about any other third-party cost. A lot of times, again, I see people that will have an AUM fee, but their advisor ultimately then works with a third-party money manager that ultimately owns sub-accounts. And so you end up in a situation where you have a couple of different layers of fees and expenses. It's where it gets a little bit more tricky and to be hidden, where at the end of the day, if there was an equity that everybody agreed was a great equity or a couple of stocks to own, maybe best to just go direct to the market, purchase those stocks versus having a couple of different layers. The red flags that you want to look out when you're asking fees and expenses. And I know this topic has become easier today than when it was 20 years ago when I got in the business. Today, consumers, investors are comfortable asking this question, and you should feel comfortable asking that question to whoever you're working with. It's a fair question. It's your money. You deserve to know. One of the things that would be a red flag is if you kind of get vague answers or vague language back, or it says something that, there's other fees that could apply as well. If you don't get a clear fee schedule that's broken down and you have to flip through multiple different pages of a 400-page prospectus, if you get any reluctance when they ask you when you ask about the fees and expenses, that could be a kind of a big red flag. If you had a $500,000 portfolio and you had 1.5% in total fees, that's $7,500 a fee in fees and expenses. The same portfolio, if you had a 0.5% in fees, that's $2,500. That $5,000 a year of fee savings over the next 10 years is $50,000. Can make a big, big difference as well. What a good fee transparency looks like is you get a breakdown of what those annual fees are. Not only seeing it in percentage terms, you actually see it in dollar amounts as well. You get a clear breakdown and you have a clear understanding as far as what those fees and expenses cover. You can compare your fee and expense versus a benchmark to see, how are your fees and expenses compared to other. There's no surprise fees or charges, and you have an easy to understand summary. So here's what I want you to do. If you don't know what your fees and expenses are and you want to find out, this is an area where resources like that are available today, like again, Morningstar, we use Riskalyze, we can take a look at the prospectuses. But if you gather up all of your investment statements, you can use a fee finder checklist. You can get a hold of our office. We'll, go through a fee finder checklist with you. That allows you to calculate your total annual fees in dollars. Then what we can do is help you compare that to where the industry averages are. And then what you want to do is you want to consider, are you getting more value than what you're paying? And then which of those areas maybe could you eliminate that weren't adding value? So we'd be happy to provide you that portfolio review, help you uncover exactly what you're paying for, and go through that fee worksheet with you, put a little bit more money back in your pocket. And who doesn't want to have more money when it comes to their retirement time? And that's exactly what we can do in walking you through understanding how those killer fees can eat away at your retirement.
I'm sure many of us out there have had the experience where we are buying concert tickets or, to a sporting event, and then we get to that final screen and we go, you know what? I like that artist, but I don't $75 like that artist. And we back away. We decide, that's not worth it to us. Now, as I said earlier, Ticketmaster is putting it right there up front. There are many times when it comes to retirement accounts, you don't find out until after you've already paid, and it's difficult to assess that value unless you do a little bit of work ahead of time like having the team at America's Retirement Headquarters do that portfolio review for you. Real easy to get started. Give a call, 419-794-3030, to let them use their years of experience to put them to work for you. 419-794-3030 for that portfolio analysis. Or you can also go online, arhq.com. There is a degree, and we've joked about this before, a degree of couples counseling that comes into play when it comes to discussing retirement, bringing all these, differences to light, and then finding, what's going to work best for both parties in play. So again, encouraging when you have that appointment with them, bring your spouse, have these conversations, and start developing that retirement plan for both of you together. 419-794-3030 is the first step. 419-794-3030. You can also go online and book a time at arhq.com. Many Americans set a goal of saving $1 million for retirement, and the number of 401k and IRA millionaires has actually grown in the past year. So where would that kind of money last the longest based on household, transportation, and healthcare costs? A recent analysis by GoBankingRates.com found it's actually Mississippi, about 22 years and 8 months. But in Hawaii, that same amount would last less than half of that, 10 years and 3 months or so. These wide differences aside, how could someone optimize their retirement savings to ensure that they last as long as possible?
Well, today we're talking about something that affects really all of us, retirement savings. And, I've got some big eye-opening numbers that might shock you on where your money will stretch the furthest in retirement time. Did you know that $1 million, that dream retirement number, it could last you over 22 years in some states, but less than 11 years in others. And what I'm doing is I'm breaking down exactly how to optimize your retirement savings to make sure that your money lasts as long as possible, no matter where you live. Because here's the crazy part. According to a recent study by Go Banking Rates, found that if you retire with $1 million, which, by the way, is more and more Americans are actually achieving through the record growth that we're seeing in 401ks and IRAs. That money will completely last different dependent upon where you live at in retirement time. So in Mississippi, you're looking at 22 years and 8 months of financial security. But if you pack your bags for Hawaii, that same $1 million gone in just 10 years and 3 months, and that's less than half the time. New York and California really aren't much better. We're talking about your retirement funds disappearing in just 13 to 14 years. Other states like Oklahoma and Alabama could stretch out your retirement dollars into different decades. So, what's the massive difference? And it really comes down into three major categories. Living expenses. So in Hawaii, retirees are spending on average $97,000 per year just on basic living cost. And you compare that to Mississippi, it's around $44,000 a year. So it's more than double what the living expenses are in Hawaii. Housing cost. That's a big one there as well. Your mortgage or rent in retirement time can make or break your budget. And the third category is healthcare. So as we age, medical expenses become a bigger piece of the pile, and these costs can vary dramatic by state. Transportation, everything that goes from the gas in your car to the car insurance to whatever type of transportation that you make. Even in hot spots like Florida, where you're seeing that $1 million could last about 18 years, it fell somewhere in the middle of the spectrum. And what you want to do is you want to really work towards developing optimization strategies. And on optimization strategy, if you considered at retirement time, you could consider relocating to a state with a lower cost of living. So say, moving from California to Alabama could literally double how long your money would last. Just remember that you'd want to pick areas and factor in the quality of your life, your proximity to family, what your healthcare access is. Strategy number 2 is you want to diversify your retirement account. So, don't necessarily put all of your eggs in one basket. You want to maximize what you're putting into your 401k, contribute to vehicles like Roth IRAs to build some tax-free wealth, and consider having money in taxable accounts for some more flexibility. Strategy number 3 is looking at the 4% rule, but being a little bit flexible on the 4% rule. That traditional advice says that you can withdraw 4% of your portfolio annually, allowing for cost of living and inflation adjustments on the way. But I would tell you to be a little bit flexible, in years that things are more expensive, maybe in the years that the stock or bond market isn't up as much as it has been recently. Could be a good time to tighten down the belt a little bit. And those other years when things go great, those would be years that you can make it work and spend a little bit more. Strategy 4 is looking at your healthcare planning. When you think about your healthcare, you want to break it down into developing strategies to minimize the amount of cost that you spend if you're going to retire before the age 65, and how to navigate if you're getting health insurance through the affordable health care. The second is navigating Medicare, understanding what original Medicare cover, deciding whether you want to add an advantage or a supplemental plan, and knowing what your maximum out-of-cost expenses are. And then the third area in healthcare is looking at how do you protect your assets if you or a loved one have some type of long-term care need in the future. Strategy number 5 is to develop creating multiple income streams. In creating multiple income streams, we're looking at optimizing your Social Security. If you're blessed enough where you have a pension, making sure that you have the right pension option selected, looking at maybe turning and shifting part of your investments from mainly growth-oriented investments to dividend-paying investments can help you protect and generate more predictable income. Using investment of vehicles like annuities can be another way that you can shift money over and be able to kind of help move money over. Get a good idea for what your expenses are, where you live at today, and or if you're going to go to a different location. It's a good idea to kind of track your expenses. I know, budgets are not a fun thing to work on in the beginning, but, having a budget in place can help you kind of figure out, what your living expenses are going to look like where you're at today. And it's going to figure out, where you're at in the future. You want to then review your investment mix and make sure that your mix of investments targets the outcome that you want to get. So again, using the rule of 4%, if you have a 4% withdrawal rule, I would generally say you'd want to build out a plan that's designed to get like 6% rate of return. So you have a little bit of extra wiggle room inside of there, and build that out into your overall investment mix, just so you have some wiggle room in there at retirement time. And then as you get closer to retirement time, it often is a good idea to, shift some of your risky assets, make sure that you have money in safe accounts and you have some type of backup plan. And then you also finally want to address the issue of inflation, building in, maintaining purchasing power, because your retirement could be 20 plus years in retirement. And you want to have some investments in there that are designed for growth to help keep you up with long-term care. So the bottom line here is your retirement location and strategy can literally make the difference between 10 years and 22 years of financial security. That's huge. What's your retirement plan? There's whether it's considering different locations, making better outcomes. Let us know how we can help, again, make your dollars work as hard as possible and help you make your retirement savings last longer.
And in case you were curious, here in Ohio, it is about 20.6 years. That's on average, of course, but you don't want just an average retirement. You want that dynamic retirement that's made just for you. And with a customized retirement plan, like the team at America's Retirement Headquarters creates for their clients, they can, help you make that money last as long as possible. Just reach out and set up a time to speak with them, 419-794-3030, or go into the website and set up a time at arhq.com. Clark Howard is a nationally known consumer advocate who has helped a lot of people when it comes to their personal finances. Recently, he was asked about how to save money in retirement.
After age 50, you're even allowed to put in mega dollars beyond what somebody younger than 50 can do. Put the money in a simple fund. My favorite, a Target retirement fund.
Now, this has not been the message that we've been talking about here on the show, Nolan. Do you agree or disagree with Clark, and why?
Well, should I invest in a target date fund? I think in many cases, there's pros and cons to what happens within a target date fund. It's been the Ron rotisserie chicken solution for financial investments today, meaning, with that rotisserie chicken that our father-in-law bought us years ago, it's set it and forget it. And a lot of times, that's what happens when you look at these target date funds. So if you're getting into your 401k or you're already in your 401k, we're going to walk you through the pros and cons of target date fund. Number one of the problems that you can get into with some of the target date funds that are out there is high fees and expenses. So what you want to do is you want to make sure that you do a fee comparison and you look at what the expense ratios are and you compare that to index fund. You can go to a website like Morningstar.com and you can type in the target date fund that you're either in and or you're considering. Then what you can do is you can compare that fund versus the index options that are out there and see what the comparison are over time. We had done a previous segment we talked about is the impact of 30 years of higher versus lower fees and expenses. And the convenience of a target date fund could cost you. The problem number two is it's a kind of the approach of the industry of target date fund is a one size fits all type of an approach. So it's very generic versus a personalized asset allocation plan based upon who you are as an investor. Those target date funds are really age-based allocations, and they don't consider your individual situation. Your risk tolerance can vary, not just based upon your age. Income, debts, and your goals matter more than what your birth year is. The problem number three is you have a lack of control. If you look at it, you really can't make adjustments to what the market conditions are. If you're looking at near-term market conditions and you feel very uncomfortable, or if you're using technical analysis and technically there's a breakdown in the market and you want to go more defensive, your target date fund is not making changes based upon short-term market conditions. It also is going to give you then less flexibility for how you rebalance your overall plan. You're really going to lose that type of control. The fourth problem that you have is performance-related issues. If you look at the performance of your investment, what I want you to do is I want you to go to, again, a website like Morningstar.com. When you go to Morningstar.com, what you can do is you can type in your target date fund. And then if you scroll down a little bit on Morningstar, you can see the performance of how your investment has been doing and look at it in comparison over a 3, 5, or 10-year basis. I have had people come in and they've asked questions like, well, how's the performance been over the last 3 months? Right? Fair question, but if you're looking at this for your retirement vehicle and you've got more than 5 years till retirement, that you're going to have your retirement money invested, worry more so about 3, 5, or 10-year performance. But if you have a target date fund, you could really find yourself in a situation where you could, over time, have severe underperformance when you look at it and compare it to index type strategies. Couple different alternatives that you can have that's out there. The one that we utilize a lot for our clients is called Plan Confidence. So if you look at the website that we have for Plan Confidence, it's really designed to try to do a specific investment selection process. The process that we go through is we break down giving the recommendations based upon future contributions. So when we're looking at future contributions, we're talking about where should you be putting your money that's coming out of your paycheck. And that advice actually can be different than the advice that you get with what your current dollars are. A lot of the times when we're looking at future contributions, we're generally trying to buy some of the things that are on sale and things that could be a little cheaper than putting it to maybe where your current dollars are. So your current dollars, meaning that your large balance that you have, they are ultimately separated out and based upon your individual goals and objectives. They fall into two categories. One is strategic. So when you're talking about strategic, we're talking about large, medium, small international stocks and bonds, and giving advice based upon being conservative, moderate, or aggressive. We also have the ability where we can give tactical advice. And with tactical advice, we are taking into consideration the market in a shorter term basis. And so when market condition looks bad, we might have you take and go more defensive. So in that example, maybe we would have you take and reduce your equity exposure and go with 50%, maybe more in the stable value or the money market account. So a target date fund, in essence, is kind of like, getting in your car and setting the cruise control. And, in situations, setting the cruise control can work. If you're going a long distance down 75, or if you're on the turnpike and you want to set that cruise control at 75 miles an hour, that might work for a long time. But a cruise control scenario or a target date fund doesn't work for everybody. If you have weather that's rainy, even if you're on 75 or if you're on the turnpike, you really maybe want to slow down. If you have bad economic conditions, you maybe want to slow down in your portfolio. And a target date fund is going to go whatever that speed limit is that's going to be set on the cruise control. Adding in the tactical allocation and adding in a more personalized approach would allow you to add gas pedal onto the plan. So when things look great and the weather is perfect, you're going 75 miles an hour. But when things look bad, you're going to slow down and kind of reduce it. If you have a 401k and you're wondering, how should you allocate that plan? And if you're in a target date fund and wondering if that's the best approach for you, let us take a look at your investment choices. We'd be happy to give you some feedback on how to allocate and whether a target date fund is good or right for you.
To continue that cruise control analogy, Nolan, as you get closer and closer to your destination, you're probably not going to go 75 miles an hour coming off the exit or, 75 miles an hour certainly in your neighborhood. You want to go ahead and take control of the wheel, take control yourself. Same sort of thing as you get closer and closer to retirement. You want to have a more personalized, hands-on approach like you talked about, like the team at America's Retirement Headquarters creates for their clients, letting them know and navigate towards retirement in a way that they see fit. That starts with setting up a time to speak with them. 419-794-3030 is how you do that. 419-794-3030. Or you can always find them online, arhq.com. I want to thank you for joining us once again here on America's Retirement Headquarters. It is the home of Retirement Tax Partners, the Retirement Guys Formula, and America's Medicare Associates. Hope you have a great week ahead of you. Nolan, appreciate the time as always. And as we wrap up, I do want to leave you with a comment.
Yeah, just remember, when you think retirement, think America's Retirement Headquarters.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.